Hello, investors. Welcome to Simpli Stocks. There is a big misconception among people regarding microcap or penny businesses. Most people chase low priced stocks below 10 or 15 rupees. However, they should be chasing businesses that are offering earnings growth. The simple logic for investing in microcap companies is since that they are small in size, these businesses can rapidly grow their sales and profits. They can potentially even double or triple their business in just 1 or 2 years. And if our bet turns out to be correct, we will receive accordingly non-linear rewards. But people ignore all the logic about what the growth is like, what the business model is, and what risks are there. Instead, they just look whether the share price is of 10 or 15 rupees. It has happened with me countless times that when I have called a 100 rupees or 200 rupees a stock a micro cap or penny company, people have flogged to comment section to argue. Anyway, if you are a smart investor, you need to understand the business growth is much more important than the share price. The earnings season is ongoing, and I personally track several microcap businesses. The results of most of them have been good. Therefore, in today's special video, I'll be discussing 5 microcap businesses from my personal watch list. These companies have delivered excellent results. Currently, they have very good valuations too, and these businesses are also growing at a very healthy rate. But please note that this video is absolutely not a buy or sell recommendation for any of these stocks. These are very small and risky businesses. Our motive here is strictly to help you understand their business models so that you can study them yourself. You must keep that in mind. With that, let's get started. The first microcap business we will study is Shanti Gold. Shanti Gold had its IPO this year in August. Like Sky Gold, it is also a B2B jewelry manufacturer, meaning they manufacture jewelry for other companies that sell it in the market. Kalyan Jewelers and Joy Alucas are two of their well-known customers. Shanti also has a sister company by the name of Utsav CZ. In many ways, both are similar. Shanti's client base is primarily in South India, and they are now targeting Maharashtra and North India for future growth. They specialize in 22-carat jewelry, where they manufacture bangles, necklaces, rings, jewelry sets, and so on. Their results have been excellent. If you look at Q2, that is in the July to September months, their sales grew by 62% compared to the previous year, and their EBITDA increased by 229%, or basically it more than tripled. Shanti's volumes grew by 10%, so you cannot say that sales growth was only due to rally in gold prices. In line with this, the EBITDA margin has also increased by 747 basis points to reach 14.7%. The bottom line performance is also good. You will see PAT grew by 375%, reaching 44 CR, which is almost 4 times the previous year's profit. The net profit margin was 10.2% in Q2. Here, please listen to me very carefully now. These results are very good. Several factors worked in their favor, leading to this 10.2% net profit margin. However, one contributing factor was the rise in the price of gold. As I mentioned, their IPO was in August this year. So they had purchased a significant amount of gold at that time from the IPO money. And when the price went up, they booked inventory gains there. This is separate from their top line or sales growth, which is good in its own right. But the profit growth and margins are inflated because of this inventory gain. Looking ahead, the management themselves have stated that the excellent margin seen in Q2 will come down. The EBITDA margin of 14.7% is expected by management to normalize to 6 to 7%. In this scenario, the net profit margin will reduce and settle at around 3.5 to 4.5%. But again, these normalized numbers are still very good. A margin of 3.5, 4.5% is excellent in jewelry manufacturing. So overall, many good things have happened in the company, but you must remember that the Q2 margins are not sustainable. They will normalize. Similar to Sky Gold and Utsav, Shanti Gold is also Mumbai based. They have a 13,500 approx square foot manufacturing facility in Andheri, and they are currently setting up a much larger facility in Jaipur. This new facility is being built across 50,000 square feet area, and it will increase their annual capacity by 45% or so, from 2.7 tons to 3.9 tons. The management has given a sales target of 1900 to 2000 crore sales for this year, which translates to a strong 70 to 80% sales growth over the last financial year. They have achieved 38% of this in H1, or the first half of the year. For jewelry companies, H2 is typically bigger than H1 because of the wedding season, which drives higher jewelry demand. So they will be able to match their guidance easily, I think. And overall, Shanti Gold is a good microcap business in the B2B jewelry space that you can study for yourself. The base is quite small, so we can see good earnings growth for some time. The PE ratio is under 20 and they have a guidance to deliver 70 to 80% sales growth. However, you must track this business very closely. Shanti Gold is a new business and its management needs to prove itself to the market. Sky Gold is a great role model for them. I personally like Chauhan brothers a lot. They have executed with a lot of consistency, clarity, and focus. Sky Gold has been my portfolio business since its market cap was 400 500 CR. Moving on, the second microcap business on our list is Integrated Industries. This is an FMCG business and they manufacture and sell cookies and biscuits under the brands Rich Light, Fun Treat, and Crazy Crunch. Their business model is quite straightforward, nothing too fancy. Integrated has a plant in Neemrana, Rajasthan, with a capacity of 3,400 tons, which they acquired in 2023. Additionally, they also get biscuits manufactured through contract manufacturing at other factories. Furthermore, they are setting up a new 5,000-ton plant in Sikandrabad, UP, which is expected to be operational by March next year. This will increase their manufacturing capacity by 2.5 times in just 1 year. So the business can grow quite fast over the next 2 to 3 years. They will have enough capacity. Integrated's distribution is concentrated in North India. They are mainly present in Uttar Pradesh, Rajasthan, Uttarakhand, Himachal Pradesh, Punjab, and Jammu and Kashmir. They currently have over 150 channel partners. As of now, about 75% of their sales come from India, and the remaining 25% share is of UAE, Kuwait, and African countries. Now, you should not make the mistake of comparing Integrated with popular biscuit brands like Good Day, Sunfeast, or Parle. Thinking that they are smaller players with less brand value. So Integrated is entirely playing a distribution game. If you go to a village or a small town or a small general store, you may or may not find Mom's Magic or Good Day there. However, you will definitely find products from a small brand you might not have heard of. The difference in quality and packaging might be there, but retailers still stock those products because they receive higher margins on them. Alternatively, Integrated can also make its products reach those remote areas where Sunfeast or Good Day may not reach. Therefore, you need to evaluate Integrated from a distribution perspective rather than a brand value perspective. Moving on to the results, you will see in Q2, their sales grew by 54% over the previous year. There was an improvement in the EBITDA margin, which has reached 10.7% this quarter, causing the EBITDA to grow by 109% over the previous year. Similarly, net profit margin also saw good growth. It has doubled compared to last year. As for H1, their sales grew by 64% year on year and profit has also doubled during this period. These are very strong numbers, and in H1, their sales have reached 537 crore and net profit stood at 55 CR. The management had projected at least 50% increase in sales for this year, and so far they have consistently performed better than their target. With their new plant becoming operational by next year, they are aiming for 70 to 75% growth next year. Growth is very strong here on a small base, and I have been tracking this business for about 3 quarters now, and management has consistently delivered good performance. Another interesting development in Integrated is the entry of a DII or domestic institutional investor. Their business is organized under a subsidiary named Nurturewell Foods. So Integrated is a holding company under which Nurturewell Foods operates the biscuit business. And here you can see that India Inflection Opportunity Fund or IIOF has acquired a 20% stake in the subsidiary. IIOF is a late stage hedge fund that invests in pre-IPO companies or those companies which are likely to go public in the near future. For instance, 2 years ago, their portfolio company Sai Televenture had an SME IPO. Similarly, Vikran Engineering, which got listed some time back, has 4% stake from IIOF. When DIIs or FIIs enter such small businesses, it gives confidence to retail investors because these institutions invest their money only after thorough due diligence. At the time of shooting of this video, the market cap of Integrated was around 600 CR and it was trading at PE of less than 10. Although it is a micro cap business, this is still very low valuation for Integrated. Integrated certainly deserves a bit more premium and respect, I think. Therefore, I would place it in both high growth as well as high value category. Now, before we move on to the third stock, a humble request. If you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel as well. Let's return to our discussion. The third business we will study in the microcap segment is Yash Highvoltage. Yash Highvoltage is a transformer ancillary business, meaning they manufacture a component used inside a transformer. Specifically speaking, Yash Highvoltage manufactures bushings. If you have ever noticed a transformer properly, you would have seen such parts like these. They are called bushings, and current enters and exits the transformer through them. Bushings provide a safe passage for current and ensure it does not spread to and damage other critical parts of the transformer. Therefore, Yash Highvoltage is a proxy bet for transformer sector. As the transformer sector grows, this business should grow alongside it. Transformer companies prefer to outsource bushings because manufacturing them requires a lot of focus. Yet, the bushing only constitute 2 to 3% of the value of a finished transformer. So, if there is any fault, the transformer's warranty and guarantee period will be extended for them. So, the investment required is high, but the return or output is low. For this reason, transformer companies are usually keen to outsource their bushing requirements. This makes a strong case for Yash Highvoltage. Bushings are a moated segment with a strong entry barrier. It is moated because power companies do not easily approve new suppliers. Since this is a critical product for transformers, orders usually go to long trusted suppliers or older companies in the market. Plus, very few players operate in this segment. Hitachi, Trench, and General Electric control approximately 80% of the global market. In the Indian market, Yash Highvoltage competes with CG Power, BHEL, MIM, and TELC. They currently have the expertise to manufacture bushings for small transformers up to 245 kilovolt, but in the future they plan to manufacture bushings for larger transformers up to 550 kilovolt. They will also be targeting exports to the USA, Europe, and Middle East in this segment. So moving forward, this will improve Yash's margins, and we should see both growth as well as strong margin expansion in this business. Let us look at their results now. Since Yash Highvoltage is an SME company, their results come out only twice a year. In H1, their sales grew by 79% over the previous year, reaching 102 CR. The EBITDA margin has also increased by 110% in the same direction. The company has benefited from good operating leverage, which led to their net profit growing by 119% over the previous year. They have recorded a net profit growth of 14 CR in the first 6 months of the year. Yash Highvoltage fundamentals are also quite strong. In this screenshot, you can see that their debt to equity ratio is just 0.2. Last year, the company's ROE was 23% and ROCE was 31%. Their balance sheet has expanded due to their recent IPO, so the return ratios for this year might appear lower. The company's EBITDA margin in H1 was 23% and the net profit margin was 14%. And as I mentioned, since they will be exporting bushings in the future, so moving ahead, we should also see margin expansion. But yes, valuation may seem a little premium to you at a PE of 50. However, the overall growth in this business is excellent, with sales growing at 79-80% in H1 alone. The management has also projected that their sales will grow at 35% CAGR in the medium term. Margin expansion is also a key trigger here, which we should start seeing next year or perhaps the year after that. And although we call this a microcap business, it is a reasonably large company with a market cap of 1400 to 1500 CR. So Yash Highvoltage is a high growth proxy bet that you can study for yourself. Now, compared to Integrated or Shanti Gold, obviously the valuation is high, but the business model is inherently stronger. The fourth business we will study is GSM Foils. GSM manufactures such blister foils and aluminium foils used for packaging medicines by pharma companies. They have a customer base of 65 to 70 pharmaceutical companies for whom they produce these foils. This is a very small business with a market cap of just 300 CR. You can also see the valuation of GSM here. It is currently trading at a PE of 20. One thing I like about GSM a lot is that despite being so small in size, the management holds investor conference calls and releases investor presentations, that too on a quarterly basis. We have previously studied GSM on our channel once or twice, so we won't spend too much time on it now. Let us move straight to their results. In Q2, their sales grew by excellent 86% over the previous year, reaching 58 CR. The EBITDA margin improved by 1.15% to 11.4%. The bottom line, or profit after tax, saw a massive 107% growth. This means the profit more than doubled compared to the previous year. On a half-yearly basis, sales grew by 111%, reaching 110 crore in the first 6 months of year. The company earned a net profit of 8 CR on these sales. Seeing these numbers, we can conclude that business is showing very good growth and it is moving in the right direction. GSM's management had projected sales of 200 to 250 CR for this year, which translates to a very good 50 to 85% sales growth over the previous year. However, we can see that their performance so far has been excellent. The sales growth guidance was 50 to 85%, but the H1 sales growth has been 111%. So this suggests the management has been performing much better than their guidance. They currently have an approx 8,000 square feet manufacturing facility in Vasai of Maharashtra. And for future expansion, they have rented a new plot of land in Ahmedabad, where they will set up a new plant with a carpet area of 17,000 square feet, almost 2 times the current plant size. Their Vasai plant is currently running at 70 to 72% capacity utilization, and the Ahmedabad plant is expected to become operational by the first or second week of December. Their target is to reach 50% capacity utilization there by March. So we have good clarity on GSM's growth plans as well. So this is another business that you can study yourself. Another microcap business that reported very good Q2 results is Sejal Glass. This is also a portfolio company of famous ace investor Sunil Singhania. And just 2 weeks ago, we analyzed Sejal's Q2 results in a separate video. Therefore, we will not repeat that analysis. I'll put the link to that video in the description for you, complete with a timestamp. So make sure to watch that video from there. Now, if you did not like this video earlier, please do it now. These micro caps are very special yet hidden stocks. Researching and studying them takes a lot of time and effort. If you support us through the likes and subscriptions, we will be able to bring you more videos like these. Also, let me know in the comments which micro cap businesses do you track. We often hear very good names right here in the comments of our videos. So if we find a good promising business, we may even create a video on it. Rest, I'll see you in the next video. Happy investing.